Hi everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and author of Australian Property Finance Made Simple. And welcome to today's video where I'm going to give you a really good update on what's happening in June in the Melbourne property market and to some extent the Australian property market in 2020. And today what I've done is also I've invited Cameron Fisher from Changing Places Real Estate to join me for a bit of commentary specifically around tenancy laws changing and what's happening in the industry from a property management perspective, but also long-term trends as well. So thank you, Cameron, for coming on to the office today and joining me for this short video.
An absolute pleasure.
I know your time is very valuable. You're always out there looking after the vendors and tenants and buyers and sellers. So
probably even more so with what's happening out there with COVID-19 and that.
So how are you finding the market yourself, given what's happened in the last 6 months, which is really, we've never seen anything like this before?
Very busy on the property management side because you've got this thing between tenants wanting to pay less, but landlords still need to pay their mortgages, and that's where the real problem is, because you can't pay it if you're not getting the rents coming in. So there's that sort of clash between landlord and tenant at the moment, and where the meat in the sandwich trying to appease both sides, which is making it very interesting indeed.
And it is a catch-22, isn't it? One doesn't have, you haven't got the wages, you can't pay the mortgage, therefore you can't pay the rent.
Yeah, you can't pay your mortgages, you can't pay your rent, can't pay your land tax, can't pay your, all the various fees that come along, and it's making it tough on people. But at least they're getting some chance to defer mortgage repayments and things like that, which hopefully it'll see us past all of this.
Well, let's talk about that more a little bit later on. Let's unpack that topic.
For sure.
What I want to do is just to give everyone a sense of where we are at the moment. I want to look at some stats and some charts.
Yep.
and go through what's happened in the last 4 months. And then definitely this is something I want to unpack and go into much deeper, because I think a lot of people, especially people that are investing for the first time, they might be concerned about getting tenants in. What will happen if they don't pay the rent? Or what are their responsibilities? Can you evict them? Can you not evict them? All these kinds of questions that I'm sure a lot of our listeners have. Bit of a disclaimer before we get started. None of this information that we're going to be covering today is considered financial advice. These are just purely our opinions. We haven't sat down with you and we are not financial planners. So please don't act on anything that we tell you to do today. These are just purely our opinions, especially about our predictions on what will happen in the future in the property market. Also, if you want to get a copy of my book, also I'm just going to do a shameless plug while I've got the chance, why not? Jump onto bookonfinance.com.au or Amazon or any good bookshop around Australia. My book has just gone bestseller, which is great, and my new book is coming out soon. So stay tuned for some future videos about my next book that I've just completed yesterday, literally. The end is near. And we've seen all this stuff happen, and it's funny, we were talking about these kind of Armageddons resurfacing every decade for different reasons. I remember the GFC like it was yesterday, and I was really concerned about the GFC because coming from a banking background, I'm very biased towards the banking and financial services sector being the backbone of the economy. And I remember I was trading options at the time, and I was watching all the chat rooms, and I remember when Lehman Brothers got in trouble, I was saying to people in the chat room, they're not going to let it fall because they're too big. It's part of the institution in America. When Lehman Brothers fell and then Freddie Mac and Fannie Mae fell, I thought, well, if they can fall, everyone can fall. And I was really concerned about, the Australian property market having some impact, in here, but nothing obviously happened. In fact, it created a buying opportunity. How did you find 2008 during the GFC? There was a 6 months, do you remember there was so much volatility?
Yeah, and you're right before when you said that sort of every 10 years, because, I can go back to sort of mid-70s when prices, everyone thought prices were to drop when we had the recession then, and in the 5 years afterwards, prices went up nearly 100%. Then we got to the early 80s again, where there was a recession, and Melbourne led the way and prices jumped 67%. Then you get back to the early 90s, the recession we had to have, same thing, and then you get to the global financial crisis, and again, the same thing, prices they eased a little bit and then just went off, jumped higher, quicker, and we all know what's happened, and we're looking at the same sort of thing again.
Now, you've been in real estate for 40 years.
Just right? On, yep.
I've just had my 44th birthday the other day. So I would have been 4 when you started selling real estate. You were telling me one of the first properties that you sold in St Kilda was
Yes,
How much?
a little brick cottage sold for, it was around $12,000 at the time, which seemed like a fortune.
It would have been, comparatively speaking, towards income being, relatively lower than now.
Absolutely. And it's where it's really important is people say, well, how can a house now worth $1 million be worth $2 million in 10 years' time, or $5 million in 20 years' time? It happens. That same house at $12,000 would now be worth over $1.2 million. So it's gone up 100 times in value in 40 years, 100 times in value. It's
incredible, isn't it?
So that house that's worth $1 million now, in 40 years' time, is it going to be worth $100 million? Who knows? It happens.
And I guarantee when it was $12,000, there would have been financial planners telling people, well, you can't go to 16,000. It's impossible.
Absolutely.
I mean, we might as well just buy some Telstra shares or Telecom shares that they were at the time, right?
Yeah.
And all these different options. And yet it went to 24, and then it went to 48, and it doubled, kept on doubling, which is, and looking at all the data, I've been studying the property market in Melbourne since the 1890s. Really, there's a lot of different parts of the market we haven't captured. Like, for example, the State Revenue Office only started collecting real data in about the mid-50s and 60s. There's a lot of stuff that we have to go back really and look at original titles of properties and how much they were literally sold for, and then do a comparison. But the market is very cyclical, it's quite predictable, and it has doubled every kind of 10 years in terms of the main suburbs in Melbourne.
Absolutely.
Generally, some areas definitely have lagged behind, but every decade we see this Armageddon. The funny thing is, I remember this story, Brick and Slaughter on 60 Minutes, predicting, this was do you remember this?
Yes.
16th of September 2018. The amount of phone calls I had the next day from my clients and emails, I'm not sure, did you have the same reaction?
Absolutely.
And look what they predicted. It predicted 2/5 of your home's worth would be wiped out in just 12 months, 40% in a year. Now, 16th of September 2018, that's nearly 2 years ago. And if you look at what's happened since, well, these are the stats. Let's have a look at it now, right? And this is the reason why 60 Minutes has disabled all the commentary on the YouTube video, by the way, because they were getting smashed by all the people, saying how stupid they were for running this story. And it has no substance. The problem with these stories, guys, is if you look at the journalists, I guarantee they got no property and they're all renting. Do you know what I mean? They have, which means they have no business giving advice around real estate investing. It's like a personal trainer that's never lifted giving advice to a powerlifter about lifting. You just don't do it. But have a look at what's happened since, right? And we're talking about this is for property prices from RP data for the month of May, because we're looking at, even though it's June now, guys, we're always looking back on stats, because statistics take about a month to put together roughly, from all the sales of all the agents. So even though we're in June right now, we only know what happened in May, and in July we'll know what happens in June. So everything we're always looking at, as agents, as investors, we're looking back at the market. But if you look at May, this is for the last 12 months, annual change. Sydney, 14.3% up. Melbourne, 11.7%. So what happened to the 40% Armageddon
Decline.
Bloodbath?
Never happened.
Zombies on the street, everyone running out of their houses, panic selling. Brisbane, 4.3%. Even Adelaide went up by 1.8%, right? So fantastic. Perth, 2.1%. Hobart, 6.2%. Darwin, Canberra. Darwin went negative 2.6%. And Canberra 5.1 positive, and the national average for all the major capital cities, 8.3%.
So the moral of the story is when you see those stories, that's the time to buy. It's not the time to panic and sell. It's the time to get in there and pin your ears back and buy more.
Absolutely. Do you know, I'm a typical male. I hate shopping, right? I always get an allergic itch when I have to shop, right? So what I do is I go shopping once a year for clothing, really, if I can avoid it. I mean, I get presents throughout the year from family, but I shop literally when they have the stock take sales. And I go in, I take my pills, and I spend 2 days just, buying 6 pairs of shoes and 10 tops, and, I end up probably buying 4 or 5 suits. I get my suits tailored now because of powerlifting. I can't get my arms through most of the jackets. But I always shop because the brands don't change, right? I've got my brands like everyone else that you like.
Yep.
And that the fundamentals are still the same, right? Hugo Boss is still Hugo Boss, even if it's 30% discounted, If you buy a Mont Blanc pen, it's still a Mont Blanc pen, but it could be $200 cheaper during the stock take sale. Do you know? There's always special deals they have. So, which astounds me why people are so scared with property, generally speaking, out there, and I know it's lack of education, you know, and awareness, but it's funny where we love buying things where we're getting a bargain, but yet there's this majority of this population that's largely uneducated that always thinks this is it. It's going to really happen this time. It's going to collapse and devalue to nothing.
But clothes and things are depreciating assets, or not even assets, but depreciating items.
But definitely not assets, I can tell you that, because they end up in the bin after 12 months.
Whereas, you know, the house, no matter what time you buy, it's going to be worth more in that 10 years' time, and 20 years' time, and 30 years' time. You're going to say, why did I worry about buying that? I should have bought more. That's how it is. That's how it goes.
Yep, absolutely. I mean, I love this time of the market. You know, as an investor, this is what I look forward to, because even though my portfolio would have made a paper loss, obviously I'm not going to revalue my properties and ring up the bank and say, hey guys, all my properties are down between 10 and 15%. No, what you do is you would have had your lines of credit locked in from the previous boom, and then just buying stuff at a discount. Absolutely. You know, this is the time to make ridiculous offers. You know,
Yeah.
and there'll be people out there where the circumstances have changed, where they will take a 10% discount, 15% discount. You know, so the smart investors are in the market now.
Absolutely, because it's now that the developers are feeling the pain, and it's now that they're concerned about settlements and what's happening out there, that they're going to be more amenable to a deal or throwing in all these extras that they wouldn't normally do, because they're worried about what might happen. Whereas if you're not worried about that, as you shouldn't be, you can get a great deal. Whereas in 6 months' time, the developers won't be doing the deals anymore, because there's going to be a shortage of stock being built, because people have pulled developments, they're not happening. So there's going to be that shortage, and you're not going to get the deals that you'll get right now.
I had a developer ring me. I know this developer I'm talking about. He has a project in St Kilda, and he had 3 townhouses fall over because of people buying them, not able to sell them,
Yep.
settle them. Not our clients, obviously. And the original purchase prices were around the 890 mark, and now they're on the market at 750 roughly. So it's
Absolutely.
140 grand discount in St Kilda on a 2-bedroom townhouse.
On a price that someone paid a year ago the full price.
Yeah.
So you know as the market rebounds, there's $100,000 profit just staring you in the face with that sort of product.
And that's how you build portfolios, guys. You buy those properties that are distressed. You take advantage of the situations and the prevailing circumstances. You're actually creating a solution for the developer, and he's not worried because he's already kept the deposit from the previous buyer.
Absolutely.
And what you're doing is you're waiting for 12 months for this thing to just normalise, get the equity, and you buy another one.
Absolutely. He needs the sales. He needs to keep working, because he's only going to make money if he's making sales. So he needs the sales, and he'll do them at any cost in this type of market.
Yeah. If we look at the different times in the history of the market, we had volatility. And every time we had a decline or something happening in the market, and I'm going to give you a premonition. I've got a crystal ball, and let me tell you what's going to happen in the future, guys, and you can sue me if I get it wrong. The future is a mixture of opportunities and disaster, okay? There's going to be opportunities to make money, and there's going to be people buying properties at the peak of the market, and they overshot the market, and they're going to have negative equity. But if you look at, for example, in the 90s, we had the Asian currency crisis. We had all the Japanese companies collapsing. We had, record high inflation. We had record high interest rates. You look how flat the market was during the 90s. For a number of years, it was pretty much going sideways. And then every correction we had, every decline was followed by a higher boom.
Absolutely.
And then you can see there, we had the Asian currency crisis, we had the dot-com bubble, which crashed, and everyone was laughing at Warren Buffett. And I know you guys are listening, you were laughing at him, you were saying he's too old, he doesn't understand dot-com technology. Well, who's laughing now? He's averaged 22.7% per year returns since inception of Berkshire Hathaway's shares. I mean, it's incredible. Did he miss opportunities? Yes. He didn't invest in Google, he didn't invest in Amazon, but he didn't lose. That's the main thing. And this is the biggest thing in investing, guys, is you can't afford to take massive losses. If you lose money on property or stock market, it's going to take you so much time and effort just to get back to zero. And that's why Warren Buffett, most successful investor of all time, always says, rule number 1 with investing, don't lose money. Rule number 2, don't lose money. And the banks do the same thing. The banks is always don't lose money.
Absolutely.
That's why they take a conservative approach with lending. Yeah. Then you look at the global financial crisis, the GFC. I mean, have a look at that. Just went down like a cliff in 2008 to 2010. But those that bought at the bottom of the market, And I was speaking at a financial conference during the global financial crisis. Harry Dent was there as well with his book saying sell property and buy gold and stick your money in a jar and bury it in the backyard. And I was telling people, this is the time to buy Elwood, this is the time to buy Port Melbourne, this is the time to buy Williamstown, this is the time to buy Yarraville.
Absolutely.
These are fundamentally the best suburbs in Melbourne in terms of trendy, gentrifying kind of suburbs, or you can go for the blue chip suburbs, your Hawthorns and Toorak's can get in. But the fundamentals haven't changed, except the price is now 20% lower than it was previously. And those people that have bought at the bottom, I mean, they were laughing all the way to the bank because the market then recovered and went up by 15%, you know. And then we've got the China steel glut as well, which created a bit of a sideways movement where you have all the commodity sector being affected, especially with WA, in parts of Queensland. A lot of the mines and manufacturing companies have suffered. But once again, it followed by a boom, and then we've got Corona.
Absolutely. Every time Harry Dent comes out and says the market's going to crash, that's really a buy signal. We read it the right way. It's a buy signal. I even saw on Media Watch on the ABC the other night, they even gave him a bashing, which is very unusual for the ABC to come out and say someone was wrong, particularly when they want that alarmist type story anyway. But even they said he's been wrong too many times. It's just... I don't know if he'll ever get it right, actually.
That's a good way of investing. Whenever he's in Australia selling his book, buy real estate, right?
Absolutely.
But he had a couple of times where he was right, and I always say to people, even a broken clock tells the time right twice every 24 hours.
Absolutely.
Okay, so eventually you make enough premonitions, you're going to get something right, and then you ride those premonitions all the way to the bank.
But how many times would you have sold and lost so much capital gain, you wouldn't have got back into the market?
No, it would be impossible. Yeah. And that's the biggest thing about, once you give up that equity in your house and get out and start renting, the market will move with or without you.
Yeah.
And then people will be left behind renting. And then when you feel renting, and some people are comfortable renting. We rented for a long time before we bought a house, just 10 years ago. I was happy renting indefinitely. Because I don't believe in ownership, I believe in investing, building a portfolio. But I could always evict someone out of my portfolio and move in.
For sure.
Which I've done in the past. But having that security of owning your own house is, in my opinion, as a long-term strategy, especially when you're retiring, is second to none.
Absolutely.
Because then you can't get evicted. I mean, the amount of examples we have in Melbourne of people living in a cottage in Port Melbourne or St Kilda somewhere for 40 years, and suddenly the vendor dies, they sell the house to a developer comes in, get out.
Absolutely.
I mean, how many times does that happen? Where you're getting displaced, in a time of your life that you don't want to get displaced.
Yes, it's the security of it and knowing that you've got the roof over your head that you own and no one can take it off you. And in those sort of cases, they've probably paid it off by the time they've retired anyway, and they live happily forever after in retirement. Good on them.
Exactly. So, what are we going to see? Do you think in terms of what's happening now? What's your opinion about the next 6 months, 12 months?
Well, I think the media...
Is the end near?
I think a lot of commentators just overstepped the mark straight away, and I saw just UBS said there was going to be a drop of 10 to 20% in Australian property market. They've already, and that was in April, we're only in June now, so we're talking 2 months later, they're now saying it might only be 5%. So that's an indication that people have just gone, the world's going to end, and then all of a sudden they're seeing that it's not as bad as it was, it's not going to cost as much, the stimulus packages and all that have really helped, and we're going to see a little bit of a glitch, but then we're going to see the market take off again. I mean, Melbourne and Australia are the best places in the world to invest. Property is one of the best vehicles you can invest in. It's got everything going for it. There's no reason why we won't see that very sharp uprise, and it might be 6 months before that happens. But I've got clients ringing me now asking, should I be selling, Cameron? Should I be selling? I'm concerned. I'm not getting as much rent, etc. Those people who do that will be throwing the baby out with the bathwater. They will miss a great chance of seeing the market rise and being part of it. That's for sure.
I couldn't agree more. And I know that this year all immigration into Australia has stopped. I mean, last year Melbourne had 100,000 people move into Victoria, predominantly into Melbourne, because that's where all the jobs are. And that's one of the biggest key drivers of the property market in Melbourne, is people coming in, living here. And these are not all broke migrants. There's people coming in from China, Russia with $2 million in cash. Absolutely. Going into school zones, going into the suburbs that they want to be living in, that everyone wants to be living in. And I think this year that stopped, but next year I suspect, I have no way of knowing this, just instinctively, I think with the corona shutdown, there's so many people in countries like India and China that are so pissed off with the government and how they were treated. I think when they have record high visa applications next year, to the extent we've never seen before, because people now realise that they're not happy with where they're living.
Yep.
And they looked at what happened in Australia and how easy we got through the whole process.
For sure.
Being an island in the middle of the ocean, it helps, right?
For sure.
You just shut down all the borders, and they're going to be wanting to live here in key suburbs. And I think that's going to be one of the biggest drivers of this recovery. We don't need the internal economy. A lot of people think it's always about the locals. It's not about the locals. It's about the money that's coming in globally. Yeah.
That's what's happening in Hong Kong as well. You see the unrest there. There's going to be people from Hong Kong that are going to say, well, I don't want to be living in Hong Kong anymore, as China puts the foot down harder and harder, and they're going to want to come here. And you'll see that growth happen. And as the number of new developments is drying up, it's going to cause a shortage of property. So when the immigration picks up, there's going to be a shortage of property, and prices will just jump automatically.
And I even think with apartments, and I'm not a big fan of apartments, in the last 3-5 years, I've always been telling people to stay away unless you're going to live there. But even with apartment stock, because so many of it has been shelved, 30-40% of new projects have been shelved in the last 12 months because of lack of demand, etc., funding. I even think next year and by the end of the following year, 2022, there'll be so much demand for properties, and so many people will be priced out of the townhouse and detached house market. They're going to be looking at apartments, and I think we could be even looking at a time again, give it 2021, 22, where good boutique developments like around Ormond, McKinnon, Bentley, do you know what I mean, Hawthorne, Canterbury, in inner streets, next to the school, where there could be actually really good opportunities to go in again.
Absolutely, and particularly where the median house prices are $1.5–2 million, it's going to just drag those prices up.
Yep.
Because people can't afford those houses anymore, and they're going to be wanting to buy an alternative, affordable alternative, and apartments will be the go. There'll be changes. People still want those bigger balconies and want that bit of outdoor space with it. As long as the developers, build along those lines, they'll be winners for sure.
Yep. I mean, suburbs like Glen Iris, for example, median price, typical house, 2.5 mil.
Absolutely.
For most people, it's either they live in a 2-bedroom apartment or not even living in Glen Iris at all.
Yeah.
It's not even an option. We talk about this magic 3-to-1 ratio between the price of a detached house and a 2-bedroom apartment, and I really believe that's one of the key things to look for.
It's paramount. You've got to have that. I mean, when you look at the difference between the median price of an apartment and a house is roughly around $250,000 as a general rule, that just doesn't stack up for an investor. Where you get that 3-to-1 ratio where, the home's 1.5 million, apartments $500,000, it's a no-brainer.
Perfect. Yeah, I completely agree. That's why areas like Mitcham, for example, great area, great shopping, Blackburn, those areas, you can still get a house for $750 and 2-bedders are selling for $650. I'm thinking, well, how does that work?
Yeah.
100 grand more, I get not a really nice property, but still a detached house. And so that just doesn't work. Let's look at some boring stats and housing indicators, just to work out where we are currently, where we were. If we look at the auction clearance rates is something we always look for. Now remember guys, auction clearance rates are only really relevant for Melbourne and Sydney, because a lot of cities, major capital cities, agents don't like doing auctions there. They tend to just put them on the market and do private sales or take offers. Melbourne and Sydney, because of that competition and that's the relation between scarcity of stock and the constant demand, and also the culture of the agencies here. And Cameron, you've been around a lot longer in real estate than I have. That guaranteed commission for the agent as well, because they know they can turn the house around in 3 weeks rather than having for 10 weeks, taking offers. Would you agree? Can you do some commentary around that as well?
Yeah, look, Melbourne's known as the auction capital of Australia without question, and whilst we've had a hiccup in terms of not being able to hold auctions even, and not even be able to, for a short time, not even holding open for inspections, has really affected that part of the market. But overall, the number of auctions will start to increase. And look, for an agent, it's really important because, as you say, you've got an 80% chance, if the success rate's 80%, of getting your commission or earning your commission in 4 weeks, rather than a private sale that could take 1 week or it could take 10 weeks or 15 weeks. They can stay on the market forever. So it's really a good way for agents to earn their income, and they're going to continue to push auctions, there's no doubt about it. But it's also a good way to know what the house is worth. At the end of 4 weeks, with so many people looking through the property, the public are going to tell you at auction what they think the property's worth. And it's very hard for an agent or anybody to say you're going to do better in 1 week's time or 2 weeks' time or 3 weeks' time. The market's going to deliver their opinion on price. With a great agent doing a great auction, you get that competition going, you get the emotion going, and there's every likelihood that you're going to get a great price. But it's no use doing an auction in a block of apartments where there's been 5 auctioned in the last year and they've all sold for 500,000. Well, we know what the property's worth. It's worth 500,000. But if you've got a property where it's got that special unknown value or where you get that emotion going, that's when you can get your 10% extra. And it's just so important.
Yeah, absolutely. Would you say the agent plays a big role in that as well, motivating the buyer? To what extent do you think is the difference between a good agent, a normal agent, and an exceptional agent on price? Because this is a question I get asked from people. And let's say it's a $500,000 property. What percentage do you think that can influence? Can they really influence?
Look, a lot of homes can sell themselves. There's no question about it. But a good agent can really get you, and particularly at an auction scenario, really pushing the buyers and also making sure the buyers are there on the day. And that's where it all gets to quoting and all the problems we've had with quoting and things like that. But difference between an agency can be as much as 10%. I've got no question about that.
Yeah. Excellent. If we look at auction clearance rates of last week in Sydney, 62.2%. Same time last year, we're looking at 56.2%. So it's actually 10% higher than last year. In Melbourne, last week we had 64.1%. For those of you that don't know, 64% means out of 100 properties, 64 got sold and then the other 36 got passed in. Now this doesn't capture the passed in sales that happen after the auction.
Absolutely.
Because a lot of people wait for the auction to end and then they make offers at the end of the auction that doesn't get recorded. But last year we had 62.8%. So already we can see there's a recovery. We're 2% higher last week in our auction clearance rates than we were the same time last year. And the same time last year in June, there was no such thing as a coronavirus.
That's right.
So the people are definitely back in the suburbs that are being auctioned. And they're bidding already. And this is 189 auctions in Melbourne last week versus 215 auctions the previous week, the same time last year. So it's literally the same market. I mean, that's not a big difference, would you agree?
No, it's not. It's not. And, there's no doubt that first home buyers are seeing this as a great opportunity to jump in. And, as I said, you've got the builders, a $25,000 grant potentially. So some people will be buying a property to renovate and turn over. So there's a lot of positives out there as why the smart ones are getting in now. Yeah. A lot of people are going to say, let's wait and just see how the market goes for the next few weeks, next month, next 2 months. They'll miss out. They'll miss out on potentially a quick 5 or 10% upswing by waiting.
Brisbane 34.2% last week, same time last year 22.5%. So Brisbane's definitely taking off. And if you look at the number of auctions, 50 auctions last week versus 161 last year. So you can see there it's definitely increasing. And Brisbane doesn't sell a lot of properties at auction. Most properties are not sold through the auctions. But if you look at Canberra, for example, 68.2 versus 39.1. So really, that's really telling you that the whole thing is starting to recover. I mean, I treat this as the pulse of the market. Rather than listening to people's opinions, economists, and people always have the bias angle. What are actually people doing? Are they buying properties or not?
Absolutely.
That's what I look at. The proof is in the pudding. Yeah. So overall, we're looking at 59.8%, which is around 60%. So 6 out of 10 houses are selling, 4 are not selling, they're getting passed in. Maybe 1 or 2 are getting sold later on. It's not a dead market.
I would say 50% of those that are passed in are sold within 2 weeks.
There you go.
Because it sorts it out. You've got to listen to the market, and whilst a vendor in some cases might be a bit deflated that they didn't get what they want, after a little bit of time, they sort of come to the realisation that that's the market telling them what their property's worth, and they end up accepting a price.
Yeah. So it's not a dead market. It's a normal market that's, last year we were at 8 o'clock on the Harry Todd White property clock going to 9 o'clock, now we're at 9 o'clock. So it's a market that is signifying to me the beginning of the next growth phase of the property cycle.
Well, I think so many people sort of sat on their hands and said, with all of this going on, it's a terrible time to sell, shouldn't be selling, let's not sell. But in the end, it's created a shortage of stock, of good stock, and the good stock is really selling.
End of the day, people have kids, people have families. This whole market is driven by
Absolutely.
emotion.
People die, as you say, they need it. There's plenty of reasons out there to sell, apart from the fact that you might be under a bit of financial stress. There's so many different reasons. People get divorced, all sorts of things happen.
So there we see what happened during the June, and you can see that quick recovery. So you can see that big dip.
It's a V shape.
It's a V shape. Classic economics 101 recovery. People very negative, and suddenly the government comes back and says, all right, everything's coming back to normal now.
Oh, quicker than they thought.
And gyms are opening up on Monday, the 22nd, which is good. But you can see that V recovery occurring, and the people that bought at the bottom would have cleaned up. They would have made 10%, and now it's going to go back to normality. I tell my clients this year is pretty much a write-off in terms of if you're buying and holding and not buying anything, we're on pause. We're just going to wait to the end of the year. I think what will happen is there'll be another bit of a second wave, hopefully not, but I think it will happen to some smaller extent. I think in September, when everything finishes off with job seeker, job keeper, the 6 month period of time. Yeah, there'll be a bit of a uncertainty in the market. There'll be a bit of stock on the market, but I think by the time Christmas comes and then next year, everything will come back strong online, because the fundamentals weren't really affected. It was just we paused the economy. We haven't actually. It wasn't broken.
No.
Yeah, and so I think it's going to be a good recovery. But yeah, if you look at Melbourne, it's virtually the mirror image of the whole market. It's a V-shaped recovery in terms of auction clearance rates, down to 20%. And maybe people don't talk about this, but the reason it went down so deep is because we couldn't have auctions.
That's right.
It's not like no one turned up. They couldn't turn up.
And they were cancelled. So,
yes.
So auctions.
No one talks about these. They just say they were 20%. They don't want to say,
they don't say, well,
you couldn't turn up if you wanted to.
That's because we couldn't hold them.
Yeah. That's an important thing to mention to people, because people look at, what happened there? Well, everything got shut down.
Yeah, so there might have been a few online auctions, and that gives you your 20%, but that was basically it.
Yeah. So it's hard to do an auction when you shut down.
Yeah.
In terms of value of changes, this gives us a bit of an indicator as well where the pulse is, but I'll skip through that. I want to talk about and I don't like combining the whole market into one large market. People talk about the Australian property market. There's no such thing as the Australian property market. Even in Melbourne, the market is so fragmented now. You have the western suburbs, you've got the eastern suburbs, the Bayside. There's no correlation between parts of Melbourne, like in Sydney. I mean, some like Adelaide is pretty much still linked together. Brisbane, to some extent, there are different parts of Brisbane, but it's still a very common market. But Melbourne and Sydney, guys, if you're not from here, it is completely like a different city. There is things happening in the west that have no impact on the other side of the city at all.
Yep.
The different levels of employment, different demographics, different incomes, different industries.
Yeah.
One part is booming, the other one's going down. So having a lot of these stuff that the media focuses on, which is aggregating the whole market into one index, to me, it's not even the pulse of the market. It's nonsense statistics. I don't even know why people would do it.
One area can be down 10%, one can be up 10%, and it's
we can have Darwin going exactly, and then the thing is zero. One's going up 20, one's down 20, and then it's just craziness. So I skip all that statistics. Whenever you see aggregated stats and home value indexes and major capital cities all pulled together, you're pulling Tasmania together with Sydney. You're putting houses that are 400,000 with houses that are 16 million. Yeah. I mean, what is the point of even looking at that data?
It's the same with rental data and vacancy rates. Areas are dramatically different. Now, St Kilda at the moment, for example, has got a high vacancy rate because you don't have the backpackers coming in at the moment, and also a lot of people that had Airbnb properties have now put them on as long-term rentals. So all of a sudden, there's a huge number of rental properties in St Kilda that's not normally the case. So that distorts the figures.
Perfect example is Dockland South Bank with all the Asian students that couldn't come over to do the university degrees. I mean, there's hundreds of apartments around Caulfield as well as Clayton, which is the other Monash campus, and Melbourne University in the city, and all the other campuses, TAFEs where students predominantly stay in the city. I mean, those apartments, the vacancy rates are through the roof.
Oh, absolutely.
So, I mean, I always tell people never invest in Docklands and South Bank, but now even more so. It's just completely... it's quite bad. So what I recommend, guys, is not to look at combined cities in terms of trends, because it is very misleading what happens. As an investor, you have to dig further, deeper, niche, go down to suburb level, you know, or at least part of the city. So all these stats here, you know, it gives you a bit of an indication. Like for example, for Sydney, the average house is 800,000. For Melbourne, it's 680, you know, apartments. But so what? I mean, you know, different parts of Melbourne are growing at different rates. It doesn't really give you any indication of this is what I call nonsense statistics, because it's technically correct. There's nothing wrong with this data. It just has no real application to me as an investor.
That's
you know,
right.
There's
Because
nothing I can derive from
you're
this.
not buying all of Melbourne.
Exactly.
You're just buying in one area, so you need to know that area backwards.
Time on the market is also a way that I look at polls, which I like looking at, because if you look at, for example, in Sydney, you have the average house took 50 days to sell. Now compared to 49 days last year. In Melbourne, 63 versus 75. Sorry, Melbourne is 48 versus 48, hasn't moved. So number of days that a house is on the market could tell me how hot the market is, how quickly people want to transact.
And we're seeing that it's not much different to last year. But then again, if you're an investor, you need to dig deeper. It might be apartments are lagging and houses are really selling, which has been the case in the last year, that houses were the first to take off in the market. Everyone wanted to buy a house, whereas apartments lagged behind. But you know, we'll see apartments then start to catch up, because that's predominantly what happens.
The other part of the equation is because the coronavirus and social distancing, banks and brokers require people to take longer settlements if they're borrowing money. You know, where you could do 30 days comfortably last year because everyone's at work. Now they're saying, let's do 45, 60 days because no one's at work, everyone's working from home. There's an adjustment period.
Absolutely.
And the paper trail just takes longer to get from A to B. So that's also an indicator that of how the market is affected. Even though people wanted to settle in 30 days, they might not be able to because
nearly impossible to
the
do
banks
30
are telling
days.
them. Vendor discounting is important. I look at that a lot, which is the percentage of the average house and apartment being discounted same time compared to last year. So you can see that, for example, in Sydney, you can see 2.5 versus 2.8. And for
these are houses and units.
For units and houses, and then 3.1. Yeah, sorry, 3.1. So really 3%, 2% discounts. I mean, during the GFC it was 10%. That's a substantial discount. You know, 8, 9, 10%. 3%, 2%, that's nothing. That's just marginal.
There's always discounting. You show me one vendor who doesn't think their house is worth more than it actually is.
They're always unrealistic.
They're always got to come down a little bit. And, you know, to be honest, those sorts of percentages are very low discounts.
Almost 1.5 million Australians households in mortgage stress as COVID-19 cliff looms. You're going to see all these cliff articles coming out from now on to the next 10 years for different reasons.
This is the September cliff.
But this is the September cliff. It's always, over the last 20 years that I've been in finance, and really after finishing Monash University, my first job was at 21 and I got into Australian funds management. And so for the last 20 years, all I've seen from people that don't invest is, yes, it hasn't crashed yet. It will crash because of, open brackets, the following thing, close brackets, will occur. You know, it's always the same. And this is what I've been hearing for 20 years. Yeah, it's fine now, but wait till September. Now, September will come and go. There'll be a small correction, there'll be recovery, and then next year there'll be something else. Yeah. There'll be something in America, there'll be a war. Yes, it's fine now, but wait for XYZ to occur. And I've been hearing XYZ for 20 years. But let's cover this one because we might as well. It's going to be in the media. You're going to see a lot of articles about this. You're going to see 60-minute stories about John and Jenny in Pakenham with 6 kids. Yep. John's a plumber, Jenny works in hospitality, both lost their jobs. And now they're about to lose their house. But that's not representational of every family in Australia. And I feel sorry for those families, by the way. I'm not having a go. And I'm not trying to diminish in any way the significance of this virus having impacted certain people in certain industries unfairly, because really a lot of people had no choice but not work, you know, which is completely unfair. And I've got clients definitely that worked in the airline industry or hospitality where both have lost jobs and both are struggling financially, you know. But what they do is in the media, they take one of those families and they try to make it out like this is every Australian. This is 24 million people doing the same thing, which is not, obviously, because I know people that are booming right now. Businesses have tripled. with especially like cafes that do home deliveries.
Yeah.
People
liquor shops.
Liquor shops. I mean, alcohol consumption has gone up by 60%.
A lot of farmers are doing better.
Yeah. So, but there's almost 1.5 million Australian households that are currently experiencing mortgage stress, despite federal government support programs to help ease the financial burden of COVID-19. New data from Digital Finance Analytics, DFA, shows that in May 2020, approximately 37.5% or 1.4 million households were technically defined as being in mortgage stress. Now, mortgage stress by definition is people that are 3 months behind in arrears in their mortgage. So they've missed 3 payments, which means the banks can repossess their house and sell it. Now, they don't want to do that, obviously, because there's going to be thousands of them hitting the market. So that's why they haven't done that, and that's why they've given people that 6 months of deferring their interest on their mortgage and capitalising the interest. Before the corona pandemic began, that number sat at just 32.9%. So really, there's only been a 5% increase. Majority of those properties, and this is what the media doesn't tell you, are in the fringe suburbs of the major capital cities.
Absolutely.
In Melbourne, there's 96 estates all around the city. From your Point Cooks to your South Morangs, and then to your Berwick's and Pakenhams. And this is where people borrow 95%. They get the first home buyer's grant. They buy the house, just scrape in, and it's an emotional, huge thing. And these houses are beautiful. Usually, the way they build them these days, they are stunning properties.
Palatial, yeah.
Compared to the old St Kilda cottages from the 1800s, with the rising damp. But then, the next thing they do is they go Harvey Norman. They buy the interest-free furniture and plasma screens for the interest-free for the next 5 years on GE Finance, which kicks in at 26%, I think, or 22%. Now, they're living from paycheck to paycheck. If anything happens, it's game over, and this is what's happened recently. You don't even need to lose your job. You just need to be cut down your hours by 20% to be... It
has a huge impact, absolutely.
To lose everything. So the concentration of these properties is always going to be in the fringe suburbs, and I've been teaching people not to invest in those areas because of that risk factor. Not only because your tenants might not default, but you're going to have all these comparable sales that could be fire sold, dragging your price of your property down.
So you're going to see that, but people are going to be fighting tooth and nail to keep their houses. Yeah. People are going to have to look at other ways. At least interest rates are at record lows that allows them to stay in the game longer. But maybe we need a graph of boat sales or jet ski sales and things like that. When they're up high, when people are reselling, then you know that things are tough.
Yeah, definitely. People will sell everything and defer holidays, delay buying cars.
Pull kids out of private schools, all that sort of stuff.
And the house is the last thing to go. Having said that, I think there will be a lot of distressed stock out there in those fringe suburbs. Yeah. No doubt, especially around Point Cook, Trigonina, Tarneet, Roxborough Park, all those estates up there. Williams Landing, all those estates as well, and definitely Berwick, Pakenham, and the whole growth corridor there.
And that's going to be really tough on them because they're existing stock, but they're competing against new stock in those areas where you're getting the $25,000 from the government, to build. Yes. You're getting stamp duty savings. Then you're getting the builders throwing in another 25 grand or 50 grand to get you to sign up. So you're competing against that, and everybody wants new and sparkling compared to old. So there's going to be some problems in those areas.
And that's why I say there's no market for a 2-year-old Metricon home in Point Cook. Literally, there's no market for that because predominantly it's a builder's market. It's people coming in for the first time, buying the first home, and getting all those incentives.
And investors, they want the depreciation and all that sort of thing that you get with a new product.
So what do you think is going to happen in September? That this cliff that they will be talking about could hit 40.3% of properties being distressed. Do you think it's going to be isolated in these suburbs? Do you think there's going to be greater spillover effect into the suburbs? How do you see it?
Without doubt, it'll be the outer suburbs that'll be hit, and there'll be a lot of pressure on the federal government to keep JobKeeper and keep the doubling of Job Seeker in place, because if they don't have that relief, it's going to be very, very tough on people if they can't get a job. If they've got a job, they'll see it through, they'll battle through, they'll get there. But those that don't, will be in trouble. But we know the inner suburbs, the mortgages are far less as a percentage. The amount of mortgages might be higher, but the percentage of the value is far less, and people are more stable. And we'll see those areas, weather this storm, no problem. But the outer areas, I wouldn't want to have my money invested in those spots.
And no, very good. I think if you look at some suburbs like Melbourne, Ormond, McKinnon, for example, just average good suburbs, not top
absolutely.
end. You look at the mortgages in those areas, and sometimes you get 65% unencumbered properties, like 65% out of 100, 65 homes out of 100 have no mortgage.
And therefore people don't have to sell, therefore they're not putting the pressure on the market, therefore prices aren't dropping in those areas. Yes, they might flatline for a little bit, there might be a slight dip on some type of product in those areas, but overall those areas will do well. And when the recovery starts, those areas just go boom, because there's a shortage of properties and it's scarcity, whereas out further that scarcity doesn't exist.
Yeah. And there will be definitely a glut of stock in those areas. Would you say? I think there'll be.
Well, you have a look at the big land banking companies haven't had the sales that they've wanted over the last year. So what are they going to do to push sales? They're going to give discounts. Yeah.
And they have to, because they've got no choice.
Yeah.
So you think the government's going to come in and bail us out and
well, I think a lot of people will be hoping it's extended. It's just whether the government can afford to extend it. But we're all going to pay for it at some point or other.
Our future generations will be paying for it.
Yes.
The millennials. It's good. Can't wait for them to get the bill. So these are the areas that I deem suburbs of high risk unemployment. And I did another video about the coronavirus, and they really correlate with areas which are the so-called growth corridors in Melbourne. So you can see in the red, these are the areas that I think are going to be in trouble the most. They have the greater propensity to be affected by what's happening right now in the Melbourne property market. People in those suburbs work predominantly in blue-collar sectors or manufacturing or hospitality.
Yes.
But also they have the highest percentage of lending against their properties, up to 95%. So even if their hours get cut back slightly as an impact of the whole economy, they could lose their house. Most people go bankrupt by $1,500 per month. So the difference between bankruptcy and staying solvent, these are independent data, is about $1,500 per month. Do you know what I mean? And that could be a small amount of money when you think about it, before you have to lose everything. And just people just can't come up with that $1,500. And to me, as an investor, if anything, investment properties give you that buffer that if you've got equity in the property, you don't need to be a millionaire, just 200 grand or 100 grand that you can take out at any time.
For sure.
That could get you through these periods of time.
Absolutely.
So to me, it's the biggest risk is not having investment properties, rather than having them, because of that flexibility. And once again, the inner city areas where there's virtually no stock available, I think they're going to be unaffected. They have the lowest percentage of unemployment risk, and I think they're going to sail through. So I guess the whole theme, guys, for you guys that are listening to this video, is you got to pick the areas based on key fundamentals of demographically who lives there, where they're working, how much money they're earning.
And those outer areas will in the end be saved, and I'm sure that both government, state and federal see this, that if they don't get this infrastructure and stuff going to give people those jobs, then there is going to be serious problems. So they've got to, push forward all this infrastructure to make sure people have their jobs.
Perfect. What's going to happen in the Melbourne property market in 2020 and beyond? Well, this is something that I always go back to, and I always look at the bigger picture. I look at the longer vision. I don't look at things, yes, you have to be aware of what's happening right now, but I always look at the bigger picture. And the bigger picture is that in 25 years from now, this is from Aussie Home Loans and RP Data CoreLogic, the average homes in Australia will cost up to $6.3 million in 25 years' time. Projections, and really, there's plenty of references already of $6.3 million houses in Melbourne and Sydney already. This is not something unique. I remember 10, 15 years ago, it was only Turac that could have those kind of prices, and now it's virtually, there's plenty of properties there for 12, 15 million. 6 million is nothing in those areas. You look at Sydney, there's about 60 suburbs where 6 million is just an average price of a house. Projections show the median house price will reach that figure in Sydney by 2043, up from 1,030,000 today. Aussie Home Loans and CoreLogic survey predicts average prices will hit 5.8 million in Melbourne in 25 years' time, 2.9 million in Canberra, 2.5 in Perth, 2.3 million in Brisbane. Biggest increase in Melbourne because we have a lot of jobs here and it's a very easy city to live in, and accessibility, etc., etc.
And people can't imagine this though. They can't imagine that their home they're in at the moment is $600,000 is going to be worth $5.8 million. But it gets back to when we started about that house I sold for $12,000 and what it's worth today. But it's all right to say my house is going to be worth $5.8 million, and aren't I fantastic? You know, I'm worth so many millions of dollars. But if you sell it, you've still got to buy another one at the same price effectively. It's when you bought 10 properties at $1 million that are each worth $6 million each is where you make the money. It's not stopping at your own home because you're all worth the same. You haven't gone up compared to everybody else. Everybody else's house is worth $6 million as well. That's it.
So you have to distinguish between good debts and bad debts. And I would say your house is really a bad debt. It's there, it's an asset.
Yeah.
But in terms of looking at it from a bigger perspective, you just don't want to retire with your house.
No way.
Because then you'd be asset rich, cash flow poor. You want to be cash flow rich and asset rich.
Yeah, so if you bought interest only the house at $1 million and you borrowed the whole lot $1 million, when it's worth 6.8, you still only owe the $1 million. You've got the other 4.8 to go and spend on something. But when it's your own home, you don't have it to spend on because you still got to live somewhere.
Why don't you think people understand this? Because I know I've been in the industry for so long, this is second nature to me, but everyone in their own industry is very biased, you know? But why do you think the average person still believes, and I look at chat rooms and forums, people rejoicing the market's going to crash, 60 Minutes is going to do another story about the cliff in September, no doubt, people are going to be losing everything. Why isn't the general person out there not building these portfolios that our clients are building? What do you think?
The dream is owning your own home in Australia, and that's the big thing. So, you know, your home is your castle, you want that big home, and they keep bettering the home they've got, which is fantastic, but they've still only got the one property. You need to have income that just keeps coming in. So if you do get sick, if you do get injured or whatever happens and you can't work, it doesn't matter. Your properties are paying for you. A tenant somewhere else is paying not only the loan, but because you're then cash flow positive, they're paying for your lifestyle in the future, and that's what they've got to be aiming for. But I just think that a lot of Australians love to live now rather than looking at how they're going to be living in 10, 20, 30 years' time.
So you think it's a culture, should be right culture a little bit, and then too hard now, leave it till later? And
yeah, let's go and have fun, let's go and travel, let's buy everything we want, and hopefully we'll come out of it, or the government will look after us at the end of the day.
I really think it's lack of financial literacy as well. I think people 100%. Deep down are scared of money management, they are scared of debt, they don't understand how to use debt like a tool like the rich people do.
Yeah.
And I think people have been conditioned, especially by the baby boomer generation, who really did it hard, that you've got to get rid of all your debts. And really buying investment property is taking on more debt. So there's a conflict because I was taught to get rid of my debt. Now you're telling me to take on more debt. Oh, that doesn't feel good. Let's not do that. But they miss out on these massive amounts of money you can make in the future.
It's crazy because people are scared to take on a loan on a property, but they're happy to go and use their credit card to go and buy something at 20% interest or 22% interest instead of, you know, buying a home that's going to give them equity, or buying an investment property that's going to give them equity later on plus an income later on, and they're only paying 4%, 3% interest rates. Makes no sense.
2.75 the other day on the client. I mean, it's crazy. Cash flow positive from day one. You know?
Should be buying the 5 properties now that are going to be worth 5.8 million, $6 million in 25 years' time. It's that easy.
The last 6 townhouses that I sourced for my clients around the $1 million mark, all of them were cash flow positive from day one. By $50, $100, not a lot of money, but it's still money. It's still $5,000 a year, $4,000 a year. And they eat up about 12, 15 grand worth of tax. And all the clients practically said in different ways, well, what's the catch? I said, there's no catch. Well, it's too good to be true. You're telling me it's going to eat up 12 grand of tax, it cost me nothing, and it's going to give me 5 grand and go up by 8% on average per year. I said, yes. Why isn't everyone doing this? I said, that's what I want to know. Why aren't they doing it?
The problem is not should you be buying the investment properties to build up that equity and that income stream. It's how many you should be buying.
Yes.
That should be your hardest decision, is how do I buy the first one, get into it, how do I buy the next one, and how do I buy more? Because people who made that decision, imagine if you had have bought 20 homes 20 years ago.
Yeah, crazy.
It wouldn't matter. You could do whatever. You'd be in the top 10% wealth-wise. You'd be killing it.
Yeah. So you think the end is near, Cameron? You think it's all going to come to an end and Armageddon and
it's terrible.
I don't know how people will be running out of their mansions, screaming as they plummet in value to 100,000 each.
If you listened to everything and took it to heart, read everything, you wouldn't get out of bed in the morning. But we know that this is just a glitch. It's actually an opportunity. It's a great opportunity to get in there, buy property, and set yourself up for life. It's these opportunities that you should be grabbing with both hands, without question.
Great. Well, thank you very much, Cameron. Thank you for being here today and sharing your wisdom with us. And I hope you guys enjoyed this video today. I hope it gives you a bit of an understanding of where we are, where we're heading. And in summary, Cameron, what do you think is the main distinction to take away from this video?
I just think that you've got to look at it as an opportunity. Every time that there's the doom and gloom out there, or when there's been a recession or a major event, and you've seen prices, I'd say adjust, not fall, that's the time to go in there and start buying.
Yep. I often say, every time I see this Armageddon, I feel like Stephen Wright, my favourite comedian. I'm right now having amnesia and deja vu at the same time. But it's also about, just to summarise, where we are in the property cycle. And I listen to the experts always. I don't listen to journalists or people in the media that have no experience in the industry and they've got no real, results in property investing. Harry and Todd White valuers that I've been following for a long time. They created the property clock that everyone makes references to. And last year in December, we were at 8 o'clock on the property clock. Right now, we're at 9 o'clock on the property clock, going to the peak of the market. The economy is definitely on pause, but I think we're definitely going to be peaking in 22, 23, there, give or take, who knows? We could have another virus breakout, who knows? But eventually it will come to the peak, and eventually there'll be a correction in the market. So definitely the time to basically take advantage of the market, in my opinion, is right now. In fact, to some extent, the best deals were pretty much 3-4 years ago, because I know in the areas that I'm sourcing, townhouses like places like Bentley or even Sunshine have gone up by 100, 200,000 in the last few years, even with all the volatility of the market. So to me, make sure you understand the Melbourne market is very fragmented. It is not just one single market working and moving in a uniform way. It's different markets doing different things. It's a question of being a glass of water half full or not full enough. And I often say, remember this, that whatever happens in the market, 95% of people are reactive. 5% respond. Yeah. They're the ones that are investors, developers. They take advantage of the prevailing circumstances, and more money is made at the bottom of the market than any other time. There's a transfer effect between the uneducated and the educated, and it's your choice of which part of this group you end up with, whether you're going to be the reactive group of people blown like a paper bag in the wind, so to speak, by 60 Minutes coming out with stories every 3 months how the market's going to crash, and Harry Dent coming out how to sell your properties, buy gold, or you're going to be the savvy investor that buys properties. And I know investors that bought Port Melbourne detached houses for 200,000, 250, when people were telling them, you're crazy. Well, you think they're going to go to 500? Now they're 2.5 million. They went up by 10 times, and this is in the last 15 years, Or you can be the responsive person. And the choice is yours, guys, and it comes down to financial education and financial literacy. And I'll leave those thoughts with you.
They need that education, because you've got to buy in the right places and you've got to buy the right product. And if you go out there in the general marketplace, you could be overwhelmed with everything, and that's where you've still got to go to experts and use experts. It's just so important, both in terms of what you buy, but also something that obviously your book really deals with is the structures and that you need to buy property with.
Perfect. Thank you for your time. Thank you, guys. This is Konrad Bobilak and Cameron Fisher signing out. See you guys on the inside.